Hi, I'm Kara Murphy, and this is Money with Murphy. The first half of 2024 is now history, so cue the way too early Christmas in July movies, the back to school shopping, and cries for fall, at least here in Texas. We'll save those conversations for another time, but for now, let's talk about what's happened and what's on the horizon. In the second quarter, the S&P 500 climbed about 5%, clocking in a 15% year-to-date return. During that time, the market has grown even more concentrated. Tech stocks were the big winners, and the Magnificent Seven now make up 34% of the S&P 500 on a market cap basis, up from just 29% at the start of the year. Those 7 stocks have contributed more than half the return of the index over the last 6 months. On the flip side, nearly 80% of the constituents in the S&P 500 actually underperformed the broad index. For all the excitement on the equity side of portfolios, fixed income returns remained fairly dull. Among various areas of the bond market, high-yield bonds outperformed, while investment-grade bonds were mostly flat. Bond yields have been heavily influenced by inflation and the Federal Reserve. Recent signs of cooling inflation and a softer job market hint that the Fed might cut interest rates 1 to 2 times before the year ends. In the meantime, higher prices are beginning to impact customer behavior and sentiment. Real retail sales, ex cars, have been flat or negative since November 22. People have burned through their post-COVID savings, which are now at half their pre-COVID levels. Consumer sentiment has been at recession-like levels since the end of 2021. Still, helping to offset the impact of lower savings and spending, consumer balance sheets are strong. Household debt as a percentage of net worth is the lowest going back to 1987, meaning people are less leveraged than ever. Despite rising delinquencies, household debt payments relative to income are well below the long-term average, and jobs are still readily available, with over 200,000 added in June. Looking ahead, continued moderation in inflation should allow the Fed to cut interest rates. Continued growth in corporate earnings could provide important support for the market. Though investors should keep in mind that late summer during a presidential election tends to be volatile, so we advise individuals to buckle up and keep their eyes on long-term goals. And as always, invest wisely and live richly.